the sort of assumptions of the existing like financial ownership governance systems all kind of rest at this fulcrum point, which is the exit.
Welcome to the Regeneration Will Be Funded. This is a show about regenerative finance, exploring pathways to a life-affirming economy. I'm your host, Matthew Monahan, and today's guest is Razo. Derek is a co-founder and managing partner at Common Trust and a partner at Purpose US. Both of these organizations are working at the frontier of steward ownership and alternative economic models. This is a conversation about an enormously important part of our economy that I think is also under-discussed, which is the exit or sale of businesses, especially small and medium-sized ones. This is an important discussion because there are hundreds of billions of dollars in assets changing hands as the baby boomer generation retires, and the current pathways to exit are broken. Derek shares that 3 in 5 businesses are needing exits within the next 10 years, which represents roughly 30 to 50% of the equivalent GDP of the US, or hundreds of thousands of business successions per annum. Derek also shares that roughly only 2 in 10 businesses ultimately reach an exit, and most of them regret their sale afterwards. So there are limited options and the odds are stacked against you. Most of these assets then either end up in private equity funds or the small businesses lose out to larger corporates. And so what we see is this continued sucking of local value into large multinational conglomerates. So what Common Trust has been doing is evolving a structure where companies can do an inside exit, selling mostly to their employees and retaining governance with those who are closest to the company. This is about finding win-win-win scenarios between the seller, the employees, and the providers of capital. They achieve this often using an innovative vehicle called a purpose trust, which was recently popularized by Patagonia, which made Earth its shareholder and recently exited with purpose. In this conversation, Derek walks us through how all of this works. And in the second half, I ask him how it can be applied to the climate finance space, where we're seeing a lot of new funding come in, especially at the early stages of things like climate tech. But it's predicated on the business as usual exit liquidity options, which I think risks exacerbating this ownership and governance mess that we've gotten into. Derek offers some terrific reflections and shares about a land trust that they recently converted into steward ownership. Overall, I really appreciate how Derek offers a healthy dose of pragmatism, a solution that's already here, ready to be implemented into a critical aspect of our economy. Okay, let's dive right in with Razo. We are here with Razo. Derek is the co-founder of Purpose US and Common Trust, backed by popular demand. Welcome back to the show, Derek.
Yeah, thanks for having me. Glad to be here.
This is our second conversation. We did one last year. Excited to catch up with you and hear all of your takes. First, let's start with what is Common Trust and Purpose US?
Yeah. So Purpose US Foundation, we started about 6 years ago, really focused on we say like rewriting the rules of who controls and benefits from assets in the economy. And the goal there is really around innovating new models of ownership, governance, and finance that align more with goals around, health and sustainable growth and stuff like that. And then Common Trust is our company that we built, which kind of takes some of the work that was research work in the Purpose US context and is kind of scaling that up, specifically working with business owners who are looking to transition, sell their companies either to employees through this vehicle called an employee ownership trust. And we work also with like purpose-driven founders who are looking to transition their businesses into like purpose-driven ownership structures. So like Patagonia style things.
hmm So the big, I guess, selling point, as I understand it, is this notion of exiting to purpose,
Yeah.
exiting to employees,
Yeah.
exiting to community. Basically just like not a traditional IPO, so to speak, or a traditional M&A transaction.
Yep.
And you have built kind of this array of services and scaffolding
Yeah.
and mimetic space and so forth in and around that context.
Yeah.
Is that a good read?
Yeah. I think
Yeah.
so. Yeah.
And so why is that the focus?
What we found in the context of doing a lot of the research and development and kind of advocacy work in the purpose US context was that the sort of assumptions of the existing like financial ownership governance systems all kind of rest at this fulcrum point, which is the exit. That's where value is functionally calculated. That's where you have the like actual money gets made. You actually get liquidity, right? And so what we kept running into as we're trying to innovate on these new ownership governance and financing structures is that even if the exit is 10 years down the line, it has all these like really meaningful implications for what you're able to do on day 0 or day 1 of a company. And the other reason is that what we found is there are these sort of special points in the life cycle of an asset or a company where you have an opportunity to make a change that can create a ton of impact value into the future. And that impact can go one way or it can go another. And the exit is this really powerful point where you can say, okay, we're going to change the rule set. And we have an opportunity to change the rule set because we're cashing people out and giving people liquidity who have worked for many years on this thing. And so you kind of use the opportunity of a win to create a future win rather than, pass the burden onto the next owner to figure out the future win. And that's especially important when you're talking about working with employees, community, and purpose, because there are sort of unrepresented aspects of the company's and the assets, value and purpose and reason for being.
Right. So the exit events are a chance to, I guess, have an outsized influence on the incentive structure,
Yeah.
kind of the orientation of the organization, business moving forward, the mission
Exactly.
alignment, who are the stakeholders around the table.
Yeah.
And so maybe we can, paint a picture of what is business as usual and kind of the traditional path of how this is operated, and then what is the vision for how this happens in a more regenerative economy?
Yeah. Oh, big question. Okay. So I think business as usual looks different in different sectors and industries and scales and sizes and stuff like that. So we might have to like separate out a little bit. But, for a normal kind of smaller mid-sized business, we take like a manufacturing business or something that has like a lot of impact on a community and can be like the anchor institution for a community's like workforce and jobs and wealth and stuff like that. What you would tend to see is someone starts a company throughout the history of the company, it grows, it accrues capital, it accrues assets. That value accrues into the value of the company itself. Usually owned by a single owner or, a small group of owners. And maybe you would take on debt financing to grow or to acquire assets. Maybe you would take on equity investors in order to get the company kind of to the next level in various ways. And then at the time of, retirement, let's say, is probably the most common one. You have this opportunity and this challenge, which is that you have an owner or a group of owners and investors who are now looking to cash out, take value off the table, and you're sort of at that point given a couple options, but all of the options, there's really only two paths. There's the sort of like inside exit and the outside exit. The outside exit is everything that we would call like business as usual, right? It's like, oh, I'm going to sell to a competitor, or I'm going to sell to a private equity firm, or I'm going to sell to a, multinational that's like acquiring this like particular type of asset right now or whatever. Then the inside exit, which would be like less of the business as usual, it's like, oh, I'm going to sell to the employees. I'm going to like, bring in some like community ownership. I'm going to create a like purpose-driven ownership structure. Anything there would be kind of non-business as usual. So that's like and I think that is usually where we stop telling the story of a company. And I think it's a really important point to name because in some ways, like what is equally important to how the company gets started, how the company starts to become and becomes an anchor institution in a community, what is just as important is what happens after the exit. What happens when, people do take cash off the table. And it turns out, maybe this is just common sense, but it turns out that like how you do that really, really matters to the long-term outcomes to all the stakeholders, including the owners. There's this amazing statistic from the Exit Institute, which is like 75% of owners regret their sale, right?
Wow.
Which is huge, right?
Wow.
That's like a massive failure in the market, depending on how seriously you take these kind of stats. So
if I hear you correctly, if I can just jump in there.
Yeah.
So I'm, a car mechanic. I start a business when I'm like 40 and I'm in a small town repairing cars.
Yeah.
Right. And then the business grows and I end up with 2 or 3 more mechanics on staff. And, there's a person in the back office. Now we're 5 or 6 people. We've expanded the garage. We've built a relationship over the years with all of the different people who rely on us to come get their car repaired, And then I wake up and I'm 65 and, my elbow's shot and it's time to retire. And, I have a few staff members who are deeply loyal to the business. We've been working together for decades or some huge period of time.
Company has put their kids through college, it's
Exactly. We have, 401k, benefit things that we've been able to do in the last few years when times were good. We have, the sign is rusted, but it's like a mainstay on our street.
Yeah.
But I'm asset rich, cash poor.
Yeah.
Right. Like this business is worth something, maybe hundreds of thousands, maybe $1 million, couple $1 million bucks.
Yeah.
But how do I actually get assets translated into retirement funds?
Yeah.
I was the first money in, the last one to get paid. Like now it's time for me to have a graceful retirement strategy.
Yeah.
What are my options? I can sell to the larger mechanic chain that doesn't treat its customers as well, is ultra focused on efficiency, has some bigger and better equipment, gizmos in the city. Not sure if they'll even keep this location. They'll probably move us. They'll jack up the prices, We've kind of made our bread and butter somewhat by not being that guy.
Yeah.
Right. But that's kind of the, and they'll offer us a deal that's not that great, but hey, at least it's cash. No one can hate me for doing it, but it wouldn't be ideal. Or I can go to one of these complicated private equity types of situations. They're going to hollow out the employee benefits plan, add a whole bunch of debt to the capital structure, lose the soul of the business, with all due respect to private equity space, I'm overgeneralizing here, of course, but that is the reputation. Or what? I can just like keep going and just keep trying my best.
You can try to pass it on to your kids.
Try to pass it on to the kids,
That tends to be less successful.
My daughter's not really that interested in it. Her dream is not to run dad's car mechanic business, but we can try. And so have I painted a picture? Yeah. Okay. Yeah. Please proceed then. So like what is this new alternative of exiting internally?
Yeah.
Like, how do I do that?
Yeah, that's a great picture. So going from there, if you're going to sort of do this alternative thing, the way I like to think about it is like you have a couple different options. They all center around like an inside exit, and the most suitable people tend to be the employees of the business, right? The reality is, and part of the reason this isn't more common is because, the employees are not necessarily flush with cash either, right? And so oftentimes, the more conventional way to do this would be you take your sort of GM or your like general manager, right? And you sell the business to them. They go and they get a loan from the bank and buy you out, or SBA, and they buy you out. And okay, cool. You've like now transferred the business. In a way, though, you've just passed the problem on to them,
right?
Because now they have to service this loan, and that's still good. That's still going to create better outcomes, like you said, for the community and for the customers and for the other employees. And increasingly, there's more options, and a lot of these options revolve around setting up a new institution, like a trust is the structure that we tend to work with. The trust then is kind of this agreement between the owner who's leaving, the employees as a whole, including and especially the kind of leaders of the company, and the company itself as a interested party, right? And it's an agreement about how the asset is going to be managed going forward. And it tends to be the case that the way these things are set up is that they kind of take the pressure off of the future sale. And the way they do that is they kind of spread out the buyout. They make the financing a little bit more accessible. Usually the owner is kind of financing part of it, with their equity. And this creates this kind of everyone takes like one step back so that everyone can take two steps forward type of dynamic. And it's really powerful. It leads to amazing results. It's like available and a thing that you can do right now today. There's tons of examples, and yeah, that's kind of like.
So we create good mechanic trust.
Yeah.
And that trust now gets the equity of the.
Buys it out over time
business.
From the owner on behalf of the employees.
So it's not just this punctuated, random, one-time event where all of a sudden I go from, a bunch of stock to a bunch of cash and sign a deal. It's that there's a graduated amount of investment. And
the reality is that like when you work with a private equity firm to exit or, many of these other options, you're also still going to take,
vesting.
There might be, there's going to be some cash, but there's still going to be like a longer term buyout type of structure. And you can, of course, also do the kind of cash upfront model with this kind of exit to employees or community or purpose. But it tends to be the case that, people want to structure a transaction that works for all those three parties, right? And what that transaction normally looks like is some amount of cash up front, some amount of cash over time, and everybody's kind of agreeing, hey, we want to protect this thing. We want it to remain in our community. We want it to continue to create jobs. And then to go back to your original question about what the story looks like, I think this is like a key pivot point because from there, what you see is all the stories that you told before about the other options, right, are all about extracting more value in the future. And it is true that these companies go on to do like really meaningful profit share and sometimes like also buy out the next generation of leaders. And you can do all those things. But writ large, what you're seeing in this alternative pathway is reinvestment and benefit sharing. And that's really like, it sounds really basic and common sense, but that's the thing that is unique in a way. And when we're talking about, it can feel really heady to talk about like regenerative financing and stuff like that. But it's really just, do we extract more than we reinvest?
Right.
Are the people who we share with a group of people that are actually connected to the thing? Are they absentee from the thing? These are the questions that like I think define this alternative pathway and story and kind of show how it's so different. Even though it's not, we're not inventing some new financial instrument necessarily.
But just to make sure I'm landing the actual structure of one of these internal exits. So we have this good mechanic trust that now owns a meaningful portion of the business.
Yep.
I've been able to cash out some of my shares. What happens with kind of the employees who maybe are taking on more of a meaningful skin in the game? They are able to get shares as well?
Yeah, in some cases. I think there's a lot of flexibility in how you design these structures. Most important thing to say is like, oftentimes what we're trying to go for is like a win-win deal between the different parties, right? So you're saying like, okay, you're gonna, the most common structure is that as the ownership of the selling owner goes down, right? Your Matthew's auto shop is de-risked and from your ownership perspective, and you're able to kind of diversify.
Yeah. I used to own 60% of this thing. Now I own 30%. Yeah. Soon I'll own 10%.
And that's a very different position to be in, right? Because now your retirement funds are a little bit more secure and you've got more options. And as that happens, the employees are, or whoever you're like exiting to, whatever the structure is, are gaining more and more of the ownership, of the profit sharing usually of the company. So there's this really direct relationship between, there's a nice incentive lineup too, which is that there's a direct relationship between me as the GM operating the business profitably and successfully and continuing in the way that we've, built our secret sauce or whatever.
Right.
There's a direct relationship between that and the owner actually getting the retirement that they have worked so hard for.
And this is predominantly afforded by debt financing.
Yeah, in a lot of cases.
And that debt financing is coming from Common Trust, your organization.
In some cases, and in some cases, we really like working with local banks. We really like working, in some cases you can work with the SBA, government kind of backed loans.
Got it.
There's a ton of options there, and not everyone chooses the debt path. A lot of small business owners are pretty wary of debt, and so sometimes they'll finance it through, more flexible methods, equity buyouts over time or whatever. But that's like a bit in the weeds. But
right, because it depends on how profitable is the business, how much funding, how much cash and liquidity needs do the different parties have. Who's at the table from the employee and management perspective.
Yeah.
What's the appetite of the banks? So these are boutique every time deals, so to speak. But I guess the patterning is what you're identifying as this kind of exit internally. And if we can do that, then importantly, it has these really positive downstream.
Yeah, hugely positive. We help
because we're keeping the company like locally connected to its stakeholders.
Yeah.
We're not creating these abstractions.
Yeah.
Where all the decisions are made from spreadsheets by people who have no relationships with the company.
Exactly right.
Right.
Yeah. Yeah. And, it's easy to feel like this is all very theoretical, but, I like the auto mechanic example because, of course, we have transitioned companies like that, including an auto mechanic in Utah, Clegg Auto, which we helped convert a few years ago. And it's cool now that we've done a lot of these and we can actually look at the results.
Right.
We can say like, okay, what does it actually look like? And, Clegg Auto is distributing profits, that equate to a meaningful percentage of people's overall paycheck on a quarterly basis. They're still growing. They're still reinvesting. They're also doing some like community donation stuff that we set up as a part of it. And so you have this like true reinvestment economy that gets set up on a micro level. But you can easily imagine that scaling up, and being like the default of, okay, what we expect,
Totally.
One question I often ask is like, what would happen if you, took this to its kind of logical conclusion, right? You would have local economies with a dramatic amount of reinvestment. You would have employees that felt vested in the local economy, local politics, local civic infrastructure, and you would have a customer base that was actually recycling its money into its community and back to themselves, rather than having it extracted and sent away to New York or whatever.
Right. Yeah. It's so resonant and coherent with localization movement.
Yeah.
It matches kind of what people are calling for with a shift to a more relational economy.
Yeah.
It maps to the incentive structures that are really well aligned. And I guess a big problem is like, I'm really good at being a car mechanic.
Yeah.
I know nothing about complicated financing deals, exit, M&A stuff. Like, I don't even have time to deal with all of this nonsense because it's still like requiring a lot of attention. Just
you got to run the mechanic business,
So like that gap in the infrastructure of the markets to really provide these types of services for especially small to medium-sized businesses.
Yeah.
I'm taking it that's kind of what Common Trust is identifying as the opportunity.
Yeah, and that's exactly where like technology and, product building can actually solve those gaps. And we've made a lot of headway on that.
Right. So how large is this opportunity or this set of challenges with the kind of amount of assets changing hands?
Yeah. It's sort of unfathomably large. I know that I think you talked to Severin, who's working on the kind of like land side of this, and I see us as kind of working on the business side, and there's a couple people in our network who are also working on the real estate side. But overall, we're just seeing we're in the middle in some sense of what is going to be maybe the largest transition of assets in the last 50, 100 years from the kind of baby boomer generation to question mark. And that is across all asset classes. That's across all regions. It's across all industries. And, the stats are, I'm more familiar with the business stats than anything, but the stats are, 3 in 5 business owners in the US are going to be looking for an exit or a transition out over the next, 10 years-ish. And that represents something like, 30 to 50% of the GDP of the US, for which, we will need to be doing hundreds of thousands of business succession transactions a year if we want to keep those businesses. And we're currently like an order of magnitude below that.
Wow. So it's a big deal.
It's kind of a big deal. Well, I think, so in all seriousness, I think it's a big deal because if what we care about is building new approaches, demonstrating how to build new institutions and new rule sets that change the outcomes, like the mechanic shop, it's an opportunity to do this experiment at such a scale and in a very short period of time, in a way that actually we could theoretically in 20 years point to this challenge and say, like, look, we made a different set of outcomes happen by choosing a different set of approaches. And, this can be applied into the future for the next 100 years of how we develop economies and grow them.
Yeah. So you raised a fund since last time we chatted.
Yeah.
Can you tell us more about that?
Yeah. So the fund is Groundwork. It's the first fund in the country specifically dedicated to helping facilitate these buyouts into these trust ownership structures, employee ownership trusts and purpose trusts. It's a private credit fund, very somewhat traditional in its structure overall. But we've managed to really build it in such a way that it aligns. Again, of course, we really care about the incentives and making sure that they're lined up. So we built it in a way that really allows us to line up and be on the same team as the owners and the employees who take over the business. So that's exciting.
Okay, so when you say debt fund, that means that the capital has been loaned to you, or okay,
yeah, it's more that they invest in the fund. Investors, LPs, invest in the fund, and then we loan it out, and then as it's paid back, you pay off the investors. Yeah,
got it. And so you're not only helping these small businesses and medium-sized businesses exit to employees and community, but you're putting skin in the game in some of these structures as well.
Yeah, exactly.
Nice. Can you share any more about some of the deals that have been done, or kind of some of the entities that are around the table?
Yeah, in terms of Groundwork or in terms of overall? Yeah.
Okay. Overall.
Cool. Yeah, a bunch of stories. One thing that has been really interesting is, it's really easy to tell the story of why you should do this for your auto mechanic shop, especially given the stats, right? It's like 2 in 10 only 2 in 10 businesses will succeed at selling, by the stats. Most of them who do succeed will regret the sale. And there's a ton of these businesses, right? And especially if you're sort of below the 3 million EBITDA line,
right?
Selling the business is meaningfully harder. One interesting thing that we've been seeing as a development, though, is the structure and this approach being really resonant also for larger businesses, for tech businesses. We just converted the first software as a service company into an employee-owned trust.
Cool.
Super exciting, definitely not their only option,
right,
but a preferred option. It's a company called Textamol. It's in Frisco in Texas. We just co-hosted the first conference of perpetual purpose trust and employee ownership trust owned companies and leaders with them in their new, fancy office. And so it's a good example of the applicability of this idea and these structures, both to local Main Street businesses, but also to high growth tech businesses with, high margins and a really, almost the story that I think is really interesting there is the founders, Brad and Hai, are these two extremely smart, extremely sweet guys who started this company, providing these jobs, really care about culture, have built this really special culture, and who kind of looked at their range of options. And, of course, one option is to sell to, like we said, sell to a competitor, private equity fund, whatever. And after iterating through, basically every option over a period of multiple years, including other forms of employee ownership, decided on this pathway forward because they like the idea of preserving this thing that they built. They have this idea of becoming a 100-year company, right? And in order to do that, you cannot build a 100-year company without really tackling the incentive problems head on, right? And so it's a really beautiful frame to then come to this question of how do we solve the problem of the quote unquote exit, the liquidity, the transaction, or the transition. And so amazing story, but
Cool.
I think it's important to tell the story about this as an option for your kind of average business. But it's also important to tell the story for your exceptional businesses, right? Patagonias and SaaS companies and stuff like that.
Yeah. I'm glad you took it there, because I think that one of the things that's been on my mind is seeing all of this new capital come into investing in climate and nature.
Yeah.
And great. Like, glad we're waking up. There's an ecological crisis
Better late
upon
than
us, and we have like literally $1 trillion funding gap.
Is it down to $1 trillion? Oh, that's great.
Per annum. No, I think it's great. Like there's a shared impulse rising to preserve biodiversity, to invest in forests, to change farms, to bring renewable energy grids, to like actually make sure that we're tending to the survivability of the one and only planet that we live on for the future of all life on such planet. And it's understandably easy for that capital to just kind of fit the existing rails of the financial architecture that we have built our current industrial economy on.
Yeah.
And I just am feeling a little bit unsatisfied, to be honest, with the thoughtfulness of the incentive structure at the base layer.
Yeah.
And I just feel like we're at risk either because we feel like the problem's too big or too urgent, or we're just not questioning the basic premises of perpetual growth, venture capital, incentive structures. And I've raised VC money before.
Sure.
I've sold businesses before. I've participated fully in the full spectrum of the capitalist economy.
Yeah.
So it's not a critique of the people or trying to throw the baby out with the bathwater.
Yeah.
But it is, I guess, an informed opinion that incentive structure lends itself to certain things really well, and other things, externalities especially can accrue as a result. So, I wanted to chat with you about like maybe not just from the lens of common trust and purpose, since I know you're not necessarily, tackling early growth stage climate VC.
Sure.
But your kind of take, because you have been across the technology ecosystem and thought a lot about these types of models. Is what I'm saying tracking for you, and what do you think?
The question is like, can the current model, the way that we fund these things, solve the problem? Is that the core of it? Like, should we expect it to solve the problem? Should we expect it to create different outcomes because it's being applied to climate?
Yeah, or how can we be thoughtful in our response as we have this shift of bringing more capital into investing in climate and nature, to make sure that we get the incentive structures well attuned?
Yeah.
Knowing that downstream these things have a lot of ripples.
Yeah, I mean, I think the first thing is exactly what you said, which is the first step is acknowledging that there's an incentive, potentially an incentive problem in misalignment.
And can you help articulate what that misalignment would be?
Yeah, so there's kind of there's different incentive problems at different layers. I think the most kind of easy entry point in some sense is this idea of the timelines that we use for our investments and the way that we value assets. I think are the two, and of course those are both like I said earlier, those are both intimately connected to the exit strategy, right?
Mhm.
But those two things are if the exit strategy is the kind of downstream thing that is affecting what happens at the beginning, then those are the things that are upstream that's kind of affecting what happens later. There is this, when you get into like finance circles, there's this idea of the market rate return. And the deeper you go down that rabbit hole, the more you realize that it's a pretty subjective thing, and tends to be largely driven by sort of this idea of historical returns, this idea of like the baseline of what an asset, quote unquote, should produce based on those historical returns. And of course, the future values, like the valuation problem. And the timeline is implicit in that. All of these things add up to essentially, you could call it like if you want to use like a nature metaphor, you call it like a monoculture of finance, right? While there's many financial instruments, there's like equity and debt and like revenue-based financing and all kinds of stuff like that. What you tend to see is like the same set of holding periods, within a certain range, and you tend to see the same valuation methods, and you tend to see the same exit strategies. And so to the degree that you have a homogeneous set of approaches, you should expect to see the same set of outcomes. So from my perspective, I don't see, climate is in some ways an incredibly important, intractable problem, but in some ways it's not that different from a bunch of the other incredibly important, intractable problems that we're trying to solve with finance. And so I think it's really, affordable housing or, like the small business closure crisis or whatever. I think it's, post-pandemic rebuild. Like, I think what is important is that, same tools, same outcome. And that goes across all these different areas of society where we have really found ourselves in a position where finance and kind of conventional economic norms really dictate what is imaginable, first of all, and possible. And then, of course, like pragmatic when you're out raising a fund or whatever, trying to do something. So the incentive problem, in some ways, is like built into the core of the practice and the tool set. And so it would make sense to me that a bunch of people who are steeped in that practice and tool set and have never sort of given a whole lot of thought to the alternatives would be like, yeah, this is just how it's done. It's intractable, and it's someone else's problem.
Right. So what I hear you saying is like we have a pretty homogenous approach right now to a lot of the way we finance businesses and organizations, and it doesn't necessarily have to be that way, but we tend to kind of coalesce around certain types of fund structures, certain types of market returns, certain types of holding periods. And so, in my mind, like if we invest in this huge pulse, this surge of investments that's happening across energy and infrastructure and agriculture and so forth, it's all beautiful and romantic and fun at the beginning when you have the founder in a strong leadership position, the VC's excited about the businesses, and the team, the startup energy of really being on mission. And, when you have to eke out 15, 20, 25% growth in year 12, and the founders kind of passed on the baton, and you kind of have, now 60% or 80% of the cap table dominated by investors. And they have to make a return for their LPs. Right. So they're just doing their job. And those are like teacher pension funds and so forth. So
pretty much.
Don't question the legitimacy of that. And, now here we are, year 12, and there's the next fast-paced startup biting at our heels and all of the regulatory constraints and pressures and everything else. What happens? Well, we end up making decisions that externalize, that, compromise, that, I know this is our mission, but we have to be practical. We need to reduce our reliance on these organic materials that cost twice as much. Let's just be a bit more efficient in this part of the supply chain, et cetera, et cetera. And you essentially have this class of companies that becomes the new the new class of organizations that it causes a lot of destructive practices, or at least drifts away from the original intent.
Yeah.
And the proof of this is like, look at what's happening with a lot of our large institutions, businesses. I mean, so much consolidation happens in so many industries where there's only three or four companies that are controlling the whole thing.
Yep.
You know, and whether you're talking in food or in, you know, media or in luxury goods or tech or whatever. And like, do you feel great about, you know, Nestle and Tyson Foods and, you know, Facebook? Like, ask 100 people. Like, do you feel like they have your best interests at heart, and that it's still the same mission, and that it's, you know, fully values led, right? And so, can we not do that again with the current crop of organizations that we're funding? Or can we at least just be more thoughtful? Because everyone's well-intentioned. I mean, for the most part, it's not a question of people's intentions. It's a question of incentives.
Yeah.
Right? It's a question of what is the base logic.
Yeah.
And I think that, you know, the last point I'll say on my little ramble is, whilst climate does look like a lot of the other problems we're seeking to address with the tools of finance, I think there's another added dimension, which is just the premise of how our relationship to growth is not compatible with the usage of energy and materials at the scale of what we face as a biosphere.
Right.
And maybe let, you know, Nate Higgins and others, you know, do a better job of articulating the nuance there. But yeah, so it's even, I just think it's even more of a problem in this context, because infinite growth cannot happen with the situation we're in.
Yeah, I mean, and I think it's worth separating out like infinite sort of material growth versus infinite financial growth. It's not clear to me that you can't like keep growing the financial value of the economy.
Right.
You know, caveat. But
yeah, I mean, that's the dream, right? That we're going to see this magical decoupling. TBD
doesn't,
you know, been promised it for a while, and you know, some people like to bend certain statistics to show that it's possible, and I don't think that in theory it's not, but I think the overwhelming amount of data and evidence suggests that right now, growth in the economy, growth in the financial sector is highly correlated to materials, emissions, you know, growth, energy growth. And
totally.
That's evidenced by the fact that we've done, you know, 28 COPs and keep talking about net zero and everything else. And last year was yet another record of emissions.
Yeah.
Right. Like we are just driving straight off the cliff in terms of every number of our energy demand. So, okay, can you share any more examples where these kinds of tensions and misaligned incentives might arise?
Yeah. So I think the best way to approach it is to kind of talk about real world solutions that we've seen, and then talk about how they solve a particular incentive problem, because they're all so different. An example that I really like is we worked with a group of groups in Boston called the Boston Impact Initiative and City Life Viva Urbana in the Purpose Fellowship that we did a few years ago. Point of that was basically to help community groups and leaders around the country who are looking to transition assets into more community ownership, more sustainable ownership, reinvestment, economy type stuff, to help them set up funds for their projects. Because oftentimes the way that they're able to deploy capital to meet the needs of their community is going to be dictated by the type of capital that they get, that they can then deploy. And so we worked with this group, which is largely like a tenants rights, like rent strike type of group. You know, history there is like you have these like very, very absentee landlords who, you know, it's a very fraught market and very fraught situation overall. They are the nonprofit is kind of working to force these sales via rent strike of these buildings where they're, you know, the tenants are being abused and not being, you know, taken care of in the way that's required by the law in a lot of cases. But what would happen is, you have this ability to force a sale of the building from a functionally like a slumlord, and what you end up with is, well, who has the money to buy the building?
Right.
Well, it's the next it's the next person, and so the incentive, you've changed who holds the incentive to extract and to kind of underinvest. You haven't actually changed the incentive, right? So we worked with them on basically helping set up a fund, which is largely funded through philanthropy and like very friendly terms. It's I think a $50 million fund to basically buy buildings into community ownership. Now they're kind of the largest single acquisition land trust in the country. And so they've converted this kind of social capital that they've built over many, many years, hard-won network of people doing this work. By using one of these new structures, which is, real community ownership, real stewardship and control of the asset, we were able to support them to actualize that into, meaningful capital that they can then go and use to deploy in a way that will affect their community and have a really different outcome, right? And we know it's going to have a different outcome because the people who are affected are connected to the governance of the asset.
Right.
And so that's a good example of where, we're addressing the incentive problem directly. And the story one story I like to tell about this is I worked with this group, really like, one or two individuals from these groups were my like touch points over a period of about a year. And for the first like 9-10 months, it was just a lot of education, a lot of talking, a lot of figuring out, like really digging, you've never had a more coherent and technical and specific conversation about incentive problems than when you talk to one of these people who is like deeply affected by the incentive problem. There's no hand waving, there's no getting around, but like that finance thing is kind of like, it's a little bit extractive, but it'll be fine. Like that does not fly
right.
when you're working with a community group like this. And I think that's great. So for, many, many months, we were just supporting these touch points to educate their people and work with them and answer questions and stuff like that. And, at a certain point, I kind of got a call from our point of contact in this community. They're like, okay, cool, we're ready to go. And it's like, oh, I had kind of resigned myself to be like, oh, not in a bad way, but like I had accepted that like maybe this was just going to be kind of open-ended and maybe it would happen in a few years. They're like, yeah, we're ready to go. We're organizing a philanthropic fundraiser. We're inviting all our donors. It's going to be next week. They did it, immediately raised this like, within weeks, like had 50 million of commitments and we're out like looking for buildings to buy.
Wow.
And so it was just this unbelievable story of where like, the only thing that we brought to the table was just this like alternative structure that solved the incentive problem, right? And it unlocks this huge amount of impact, this huge amount of reinvestment, this huge amount of wealth for the community.
Wow.
Because it's latent, right? But it couldn't be activated because they refused to set up another predatory structure in their community, right? They would not do it. The integrity wouldn't allow them to do it.
That's great. Yeah, so I guess we need to keep honing in as a community around these memes, these norms, these kind of simple frames of exit to purpose, exit to employees, steward owned, like interrupting the patterns of perpetual growth, changing the incentives. I'm getting the sense that this is part of the work.
Yeah. Yeah, and a key piece there that I think is worth highlighting that is true of the kind of mechanic shop and it's true of the land trust is being very, very intentional about how we transition control. And the key point there is that there's this like subtle, hidden, but very impactful default norm in the finance and like ownership universe, which is that control equals money. right? That you can buy control.
Yep.
It's worth just like lingering on this and being like, that is a design choice. And not only is it a design choice, but it's not even the only design out there, right? Like Berkshire Hathaway has these like 10,000 to 1 voting shares, It's like, there are many, many examples of successful, competitive, real world, at scale companies that use a different model of the way that control and money relate to each other.
Mm-hmm.
And of course, like the examples we're talking about here are a little bit more maybe radical or unconventional. But I think it's really important to name these are designs. We can design these things. And we're also not the first people to ask the question about how to line these up.
Right. Yeah. And I guess just to put a fine point on it, so control and governance and monetary incentive interest, get deeply commingled into some particular norms right now.
Yeah.
But they're two different things.
Yeah. Well, and the biggest irony is that if you go and look at most fund docs, the legal documents and the control structure of most of these like large funds, they're really, a lot of them are essentially investors get very low amounts of control and the kind of managers of the funds get a huge amount of control. And so the most, in some way, like the most progressive structures are reserved for the most conventional types of instruments.
100%. Yeah. Do you think that the interventions are possible using the tools we've got? Like, I mean, you're kind of approaching it that way, right? You're like, hey, listen, there's a lot more options here.
Yeah.
How do we bring attention to some of the ones that are...
I think we're actively deploying maybe like 1%, if that, of what's possible in terms of like tools and strategies, and especially when it comes to finance and growth and liquidity and all these things. There's just this incredible set of solutions and options that we could explore almost none of. So I'm optimistic overall that if you frame it as can we design, given current knowledge and intelligence and what we know now, can we design a system that can respond differently and can have different outcomes? 100%. Yes, absolutely. Will we? I have no idea. And I think that, so the question you have to ask is like, why hasn't it been solved already? Like, why are we only deploying, 1% of our potential toolkit?
Right.
In a lot of cases, I get the sense that just having spent a lot of time in finance and, both talking to like more conventional finance folks on the business side and working on real estate and doing a little bit of stuff in the like nature finance space. My sense is that a lot of it is defaults. So norms and defaults of the finance sector, of the way that we tend to approach growth and the question of building and developing economies. That drives, I think, a lot of what's going on. And what it does is it sort of decenters human agency, and it says, oh, even though I'm, a famous investor with like, all the options in the world, like, of course, I'm just going to set up your average VC fund with exactly the same incentives and same problems because that's how this is done, right? And so I think that there's a couple different directions we could take that, but I think the norms and defaults is a huge aspect of why. Why we're not deploying more solutions. Yeah, maybe I'll pause there.
Yeah, well, I love that. I love where you're taking it. I mean, because to me, it really resonates that we give up a lot of our agency in these finance games.
Yeah.
Oh, this is just my fiduciary responsibility. Oh, this is just the way things are always done.
Yeah.
Oh, this is what market rate returns are.
Yep.
Like we're pointing to these norms or these pressures that may or may not always actually hold.
Yeah.
And so what do you see as pathways for reclaiming that sovereignty and that agency?
Yeah. It's a big question. I think there are many different answers. I know it's a cop-out, but I do think that when it comes to these kind of intractable problems, you're trying to solve them with the tools of finance, and they're like intractable social coordination issues functionally. We have this incredible amount of technological and kind of technocratic intelligence that is just like not even applied, right? It's like you've got this, I forget who said it, but it's like the smartest minds of my generation are like making buttons in Facebook, right?
Mm-hmm.
I think that's one thing is like, it's probably not going to garner the sort of attention that it needs until it's like very, very bad. And once it does, I think we're going to solve a bunch of problems really quickly. And there'll still be problems, of course, but that's one side of it. Incentive problems like these like kind of complex incentive problems, the challenge of solving them is that there isn't really like a single lever that you can pull and be like, oh, we solved it. Like, you know, now all our climate finance is, you know, actually aligned with like long-term regeneration.
Right.
It's more like there's a bunch of factors, and you know, we could make a list of 50 factors, and if you changed any 7 of them, you know, you'll probably have, or even 3, you probably have majorly different outcomes. If every fund that was investing in natural asset companies and nature and, you know, forestry and blah, 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 extended their return profile to 100 years, you would see a wildly different set of economic outcomes. But that's pulling one lever really, really far. Maybe that's not realistic. So we're currently locked into a kind of path dependency with regard to the norms and defaults of finance, tax, and law. And what that means is we're in a stage where everything is this iterative, like, ooh, we're like moving this knob a little bit, and then we're like tweaking this lever a little bit, and we're doing this thing. And I think that is working. It's just slow. And if you want to move fast, you know, you probably need to move more of the levers more in order to actually get the kind of outcomes that we want.
Yeah, I agree. Like it's a very complicated, complex set of intersecting challenges. And I mean, maybe it's really about where you have agency in the system, exercise it, right? Like yes, there's going to be certain things where your hands are tied, right? Because of you work at a specific fund and they have specific rules, or because of the only way that you can manage that capital is if you achieve a certain return profile, or if, you know, you're trying to raise funds from someone and, you know, they have constraints. Like, yes, there are many places where your hands are effectively tied. And there are many places where you can exercise agency. You know, does that fund structure have a 7-year or 10-year or 12-year? You know, is that something that's flexible? Is market rate return defined as 6% or 4% or 8%? You know, like where is that actual definition coming from? And what are those, you know, ramifications? Can you do more in terms of blended finance and integrated finance, where we're, you know, de-risking certain types of investing that's more impact aligned through the full capital stack, right? Are there ways to like build alliances with other funds or other investors, where that way we're sending a signal to the people raising the capital, the businesses or the entrepreneurs, that it's okay to have strategies around exit to community and exit to employees, or capped returns, or, you know, any number of financial mechanisms that helps to ensure that these things are more aligned. You know, can we attend conferences with other people who are actually trying to think about these things? Like there's so many opportunities for human agency to exercise itself. And I guess that's kind of what we all have to do. Yeah.
I mean, that's one. So that's the human agency story. And I think that is important. And it's basically like you are going to be you as an individual in a position of power with resources are going to be put in a constant series of tests where you have to trade off between your own best self-interest and career interest and this higher goal. That's like, that's the gist of it. And for the most part, people are just like self-interest, even if they also have a higher goal. And that's like, it's understandable. It's not to demonize anyone. But then there's also a kind of institutional story, which is, I think, overall about how do we build institutions that embed new logics, that have new, you know, rule sets, that allow us to explore different sets of outcomes. And I know that sounds very abstract, but the best example is the mechanic shop, right? It's like, okay, cool. All we're doing here is saying like, great, we're gonna use the opportunity to reset the rules of the game board. And the rules of the game board are now like more reinvestment, more sharing, more sustainability. That's actually not that hard. It's just a matter of finding leverage points where you can actually do that, finding actors who are willing to take the sort of the pathways forward and building, ideally, using that kind of like human agency story to build new institutions that can, demonstrate, influence others, and fundamentally create these like new rule sets that we can work inside of as a way of building the kind of bridge to the next thing. Because the reality is also things kind of change very slowly. If you look at the kind of arc of history, economic history, things change very slowly and then very suddenly. And so it can feel like, I know a lot of people in the space, and I think it feels like a grind. It's like, we're just like iterating and doing these like small experiments, and it's like, it takes so long to raise a fund, and then the fund isn't even the most like innovative thing that we could have imagined, and blah, blah, blah. But I think that it's important to see the broader picture of like building these new institutions, these new rule sets, telling these new stories, recentering human agency. The more we do that, the more hopefully, when the crisis comes, when there is a moment of openness and change, we get the opportunity to say, like, look at all of this proof that we've built of how this new thing can be done. And I think a lot of people that you've talked to are in the process of doing that, building these new institutions, playing with these new rule sets, and creating and seeing, successfully seeing new sets of outcomes. And the question that every single person I know in the space is asking is like, how do we scale? How do we scale the capital availability? How do we scale these alternatives? And it's not clear. It's different in every case,
right?
And kind of my theory about it is that if you can find there are more scalable leverage points and less scalable leverage points, but either way, all the work of building new institutions and new rule sets is headed in the same direction and towards the same goal.
Yeah, really tracks. And we often refer to a lot of these conversations as people building the water catchments to get ready for the much larger dislocations and deluges of capital and liquidity that I do think will come. Whether that's in a reactionary force because of the crises, or just kind of other dislocations that occur. And so I do think what you're building here is really important. Hats off for persisting and kind of grinding and continuing to do it for now several years, in this space. Want to give a shout out and a call out to how people get involved with Purpose and Common Trust.
Yeah, cool. I mean, Purpose, you can look up Purpose Economy, Google it. It's around, or Purpose US. And for Common Trust, just Common Trust. Just Google, brought to you everywhere on the internet that you can Google Common Trust. Nice.
Any final words or reflections?
I really appreciate what y'all are doing here with opening this conversation. I really do think that the conversation, having a sober and realistic conversation about how we finance and how we exit the assets in the economy and how those structures marry or don't marry control and governance with monetary interest. I think this is like in some ways at the core of the challenge. And it's the challenge that we're going to face with, like you said, the climate financing movement and the increase in climate financing. And it's at the core of many other intractable social challenges that we are trying to use the tools of finance to solve. And so, I think it's maybe one of the most important conversations we can be having. And I, of course, don't have all the solutions. Probably no one does. But I think even just talking about it and starting to demand answers is a really powerful thing.
Yeah, let's figure it out together. Derek Razo, thank you so much.
Thank you. Yeah.
All right, I hope you got value out of that discussion with Derek. You can learn more about Common Trust at common-trust.com. If you enjoyed this video, please do us a favor by liking, sharing, subscribing, commenting. This helps more people see it. And if you're feeling really generous, we'd love a 5-star rating on Apple Podcasts or Spotify. Most importantly, make sure you join our new weekly newsletter where we're covering all of the happenings across the regenerative finance space. You can learn more at maearth.com. Thanks for being on this journey with us as we explore pathways to a life-affirming rather than a life-denying economy. I'll see you on the next one.